Hello, everybody, ladies and gentlemen, and thank you for joining us. The latest episode of our Primus Live will be back to go live in the next 5 minutes. I'm excited. I hope you're excited. See you soon. Hello there, this is James, and welcome every single one of you to our latest Primus Live webinar. Now, before I introduce you to my very special co-host, remember these little live broadcasts, these little Primus Live webinars are for educational purposes only, and in no way will should ever be taken as advice. I always suggest you do your own research and do your own due diligence and know the risks at hand before entering any trade. Now, let me move on and introduce you to my very special co-host. Her name is Kaia, and she's our head of investment research. She worked as a portfolio and investment manager with exposure to both public and private markets. Before we were very lucky to get her here at FX Primus, Kaia was a senior investment associate at a hedge fund in Singapore and a vice president in Bank of America, Merrill Lynch. Kaia, welcome.
Thank you, James. Thanks for having me again.
Absolute pleasure. The pleasure, like I say, is all mine. How are you doing today, my darling? How's things?
Doing great, and I just realized maybe we should change the title of co-host to co-pilot. So I shall call it
co-pilot. That, I do like the idea of that, actually. That's not a bad idea. Co-pilot, indeed. And where we're flying to today? What's our destination with our educational series today?
Today we're going to take a flight to technical analysis. We're going to do a second series in our technical analysis course, I shall call it. Yes. But before we go into the indicators, I would like to spend a few minutes going through the markets and just giving a bit of update what has happened in the last, I would say, 2 weeks or 1 week.
Absolutely. Well, we've had very exciting trading sessions over the last 2 weeks in particular. So yeah, let's get started.
Let's get started. So, a couple of weeks have been pretty eventful. We've gotten over the post-election euphoria, but we have now started getting news flows about vaccine. So, just to go through a couple of the numbers, at the moment we're sitting about 63.3 million COVID cases worldwide. We have about 1.5 million deaths. United States leads in terms of cases as well as deaths. So they're sitting at about 14 million at this point. But 3 major companies have announced that they are in the late stage with their trials. So AstraZeneca, Moderna, and Pfizer all are about to administer vaccine, maybe the latest January, but most likely in December already. Election euphoria and the vaccine news have pushed equity markets at all-time high. So S&P has reached all-time high, NASDAQ as well as Dow Jones. But at the same time, we're seeing very low or actually negative inflation in most of the major economies. So Europe is flirting with deflation. Japan has been in deflation environment for the last 2 decades. And US is about 0.1% inflation at this point. European services manufacturing PMIs are declining, and we are seeing that US and China are slightly improving, although not significantly. So it's still sort of going lower on the economical data front. So which is very concerning because there's a bit of divergence between the, I would say, between the asset markets and the economic data. And central banks just keep pushing in the stimulus. So at this point, Bank of Japan already has 130% of Japan's GDP on their balance sheet. Absolutely remarkable number, I have to say. And very important to note that the Bank of Japan owns 60% of JGB market. And JGB stands for Japanese government bonds. And they own 6% of the equity market. Is this free market, James?
Yeah, that's pretty, it's quite wow numbers, isn't it?
It's wild. I mean, the fact that government owns the entire fixed income market, basically, 60% is majority. There's no price setting. There's no interest level that's actually determined by the market, by the risk-taking institutions. It's all about central banks. So Bank of Canada is sitting 27% of GDP, the Fed 33% of GDP, and ECB 60% of GDP. And ECB is about to have their meeting on the 10th of December, and they're going to recalibrate their tools, which means they're going to just announce more asset purchases.
Yes, well, like you said, at the moment, it's all about the central banks sort of running the game, so to speak. And the funny thing is, though, wouldn't you agree that that's been sort of the case ever since really the 2008 financial crisis? And they just haven't given up the reins since then. Obviously, we're facing another global economic, I wouldn't say disaster, but near disaster at the moment since obviously the lockdown in March. So they've even tightened their reins a little bit more. But I think, like I say, I don't know about you, but I'm used to seeing them being so active and heavily active in keeping grips of their own economies. This is, it's almost become the norm.
Yeah, I mean, Japan was the sort of first to give the control to the central bank in 90s, right? So, and Europe followed suit, and now it's the US basically. There's no line between the central government and the central bank anymore. So it's basically just merger of and feelings that we want to see going forward. And I don't think there's much independence in central bank.
Oh, can you hear me?
Did we lost the audio?
Oh, you're back. I can hear you again now. Don't worry. So carry on. I can hear you now. Carry on.
Lovely. Yeah. A bit of technical hiccup.
The show must go on, as they say.
the show must go on always.
Exactly.
We just did a quick test on the audio. James, can you hear me?
I can hear you. I can hear you perfectly now. Please.
We're going to change that back. Thank you so much.
Thank you.
That's what makes it fun. Technical hiccups.
Does. Hey, it's live.
We're going to do it. We're going to do it this. So I guess point being is that the man on the street has to keep an eye, or at least should know what the bank is doing, because there's no way we can get around this anymore. So centers are playing increasingly bigger role in real economy. Back in the day, nobody who were central. But I think these days it's become more important increasingly. And notice the politics around the central banking decision making. So Donald Trump was very actively trying to influence Jay Powell when he first got into the position, right? So he was strong arming the guy into putting more stimulus into the economy, and that's exactly what
he did, and how, you know, what he was sort of forced into the corner by Trump in some ways, wasn't he?
Sure, yeah.
You know, so very much so. I have a quick question for you. See what you think. Okay, now obviously, it was really since the 9th of November, we've seen a very, very bullish market, incredibly bullish market. As we've already spoken and discussed in the past, that was mainly down to the fact that we had hopes of a vaccine. Okay, and since then we've seen, as you've already mentioned, the very bullish market with the S&P 500, etc., across the board. We saw gold come under pressure a lot, though it's changed a bit today. But we've seen gold come under pressure. The safe havens come under pressure because obviously there was an awful lot of hope that this vaccine comes in. Now, do you think? Again, I don't think it's a right or wrong answer, but do you think when the vaccine does literally hit the markets or does come out, do you think we might see a case of buy the rumor, sell the fact when that happens?
I think that would be the case. It seems like a lot of the optimism has all priced into the markets. We've seen a bit of shift in that from March to September. It was very much about those tech names. We saw a lot of momentum for NASDAQ. We saw a lot of momentum for stay-home stocks, as I call them. But after the vaccine news, there has been a bit of rotation in, for instance. Now we can see cruise lines and casinos and, let's say, some of the REITs or real estate trusts picking up. So that the market pricing in the fact that vaccine is available, although technically it's not, and moreover at scale. We are not going to see administering the vaccine before maybe March or April. So that could cause problems in Q1, Q2 next year when you know, markets actually realize that we already are flying on the euphoria. There's nothing else to price in.
Yes, yeah. Well, there we go. I mean, that's what I'm sort of anticipating. You know, I'm sort of thinking that obviously there's been so much optimism and so much hope happened since the 9th of November. And the markets have been so exciting, let's face it, since the 9th of November. It's been really, really something to behold. But I think when eventually it does come out of the markets and people are getting their vaccinations, I can see the market going, what else is to hope for now? You know. But anyway, where do we stand for December, my darling? How are we looking for December?
A few more data I'd just like to mention. So we were talking about the central banks. The money supply has increased 17% as of 2020 to a record of $93 trillion. So supply is referred to as the M2 of the system. But that money supply has to be trickled down by the commercial bank system. And, you know, we have discussed this. So the way it happens is basically central banking to commercial banks. Hey, we are increasing your reserves, which is the money supply. And then commercial banks can that reserve against lending out money to the real, which is you and me, James. Maybe Apple or whichever corporation that wants to get money. But there's absolutely no risk appetite at the commercial bank level right now. So meaning they don't want to read that many loans as need in order to sort of inflation picking up. And at the same time, not that much appetite at the sort of borrower side of it. Like, I don't want to take a loan right now. I'm like, I just want to, you know, build my savings and just make sure that I have enough cash buffer for the next maybe year, 18 months. But nevertheless, there has been an increase in bonds and debt issued in 2020. So it's 9.7 trillion, absolute record. But if you look at the investment grade portion of that, just 1.4 trillion, you realize a lot of it is junk. Meaning those companies who may not actually survive without getting the loan are having access to capital markets. So again, that's a big favor from the Federal Reserve Bank, for instance, because they stepped into the corporate bond market in March and started ETFs, and thereby providing liquidity to those companies who maybe in a normal market situation would not get access to credit anymore. And if I jump to the one of the data points here, which is my second last, is that 20% of public listed companies are zombies, meaning that they cannot cover their own interest payments from operating income. And these companies are that actually mess up the market forces, meaning that are causing deflationary pressures, and they are also using up resources as well as capital. So capital allocation is not effective anymore in the system, and that's a big problem, I would say.
Yes, no, you're painting a bit of a scary picture with that. Definitely.
I'm sorry, but the positive thing, I have a positive thing as well, which is about stock markets is widening. Before November, we saw only 212 companies in S&P had gains during the month of October, but that has gotten much more wider. So from technical perspective, as you know, the broader the across all universe of assets, the stronger the momentum. So the fact that we have 467 stocks that gained during the month of November, it's a positive sign. But we have to keep in mind again that we had the positive news flow about vaccine. And also interesting thing is that 9% of stocks in S&P 500 we are above their 200-day moving average as per Wall Street Journal. And we've discussed 200-day average. That's sort of psychological line in the sand. Meaning that if you're above level, the sentiment tends to be positive. You're going to continue in a bullish direction, and that's what a lot of institutional investors use. Once they see a stock above 200-day moving average, most likely they are going to sort of look into it and maybe also the name.
Yes. Okay.
What else am I going to highlight? For me, interesting is also the fact that the junk bond yield is now at 4.8%. Historically, junk bond would sit around 8 to 9%, because junk bond, you sort of take on a quasi-equity exposure, meaning that when you talk about the capital structure, you always have the investment grades, then you have the junk, and then at the bottom you have equity. So if you are like the second last in that sort of hierarchy, only 4.8%, I would say from an investor's perspective, no wonder that investors are sort of going after the higher yield wherever they can find. No wonder you have so many credit funds out there. For instance, private credit has ballooned the last 5 years. Investors are just searching somewhere to get yield, especially the institutions such as, because they have to cover the pension payments.
Yeah, that's true. Very true.
So, very rosy picture. I guess where I'm coming from is that you have a bit of divergence between the equity and the credit markets. Equity always is a bit more emotional, sort of sentiment driven. You have a lot of retail investors who are in the equity market, but the credit market, the bond market tends to be more. And I always like to watch the yields and the spreads in the credit market, where the sentiment really is. And that is not even always accurate, because now you have 10 trillion worth of bonds with negative yields. And again, interesting phenomenon. But there was definitely divergence between the credit and the equity markets. And I think credit markets are seeing slightly clearer picture than equity markets are.
What a time to be alive, as they say.
It's a fascinating year. James, how about you show us some of the asset classes that we've covered in the past? Let's look what happening on the charts.
Okay, certainly. Well, okay. So, what would you like to start with? S&P 500 or gold? Or
let's do S&P. S&P, one of my favorites.
I know it is. You talk about it a lot, and like I say, it is. it is a great instrument or asset to watch, because obviously if it's riding high, then you can engage if the market sentiment is, quite bullish or not. But here's the S&P on the daily. What time frame would you like?
Let's do daily. Do you remember I was asking a question from you about S&P probably 3 weeks ago? I was asking whether double top or double bottom.
Yeah, and both of us couldn't quite decide which one it was it?
We weren't sure, but the charts don't lie, so.
It doesn't lie at all. Like I say, it is trading extremely very bullish momentum on it there. So obviously a lot of optimism.
Yeah. I mean, you don't have moving averages here, but the moving average we've discussed all stacked in a rainbow fashion. So you're gonna have 8-day, 21, 34, 50, 100, 200 all aligned. So very short and long bullish momentum. I have in parallel open another chart which is trading view. I'm not going to you, but I'm just going to open it up.
Okay.
For myself, and I'm looking at, let's say, RSI, which is neutral level, stochastic slightly overbought, and a couple of indicators we're going to discuss today. Directional movement index, so DMI sitting at, and with CDX sitting at 18. So point being, bullish trend overbought within the Bollinger Band level. I think that S&P is going to go higher from here because there's no clear resistance anymore. Since all-time high.
Yes, no, I totally agree. Like I say, I don't know about you. I remember when, like I say, when the big bull runs I was witnessing back in 2000, and what year was this now? 2017, and the S&P again was really sort of skyrocketing. The markets were very, very, very bullish, and I remember doing a number of seminars and discussions about when this bull run would collapse, when it was all over, when it was going to stop. And again, this is back in 2017. And though obviously we've had dips, we've had cases of sell-offs with the S&P, it's still not over even now, is it? Or do you think eventually, look, everything has to come down eventually. Everything that goes up must come down, as we know. But do you think, of course, not trading advice, obviously, ladies and gentlemen, when do you think we might start seeing, or will we see in the immediate future, a downturn on this?
Good question. I wish I had a crystal ball.
No. Yeah.
My answer to that is that I think the moment we're going to start inflation picking up and interest rates increasing, I think that's when equity markets are going to go lower or stabilize or become range bound sideways. It doesn't show in most markets, as we just discussed earlier. However, there's some pressure on cost at this, meaning the fact that we don't have the transportation routes available anymore. We don't have people available anymore for certain services. I think the moment these cost pressures start affecting the price, push the price higher, we're going to start seeing inflation, and we're seeing potentially higher interest are going to dampen the probably discounted cash flow projection valuation for most equities.
Yes. Yes. Yeah. No, I totally agree. I totally think it's like I say, like we always said, if we really knew where everything was going, they would be looking in an empty chair in an empty studio right now, because it's not that easy. But I do think you're right. I think you're onto something there. I think we will still seeing a little bit of change in momentum, certainly when interest rates start to rise, or when central banks are going to be in the position to raise interest rates. Maybe sometime middle of next year, they might be able to in position to do that, depending obviously how the vaccine comes in and how things slowly start to rebuild again. So yeah, I would agree on that. What else would you like to have a look at?
Let's look at gold.
Oh, my favorite.
Gold has had a very interesting run this few last trading sessions.
Yes. Well, here's gold again on the daily.
We are putting 200-day moving average on the chart as well, so our viewers can see what we're trying to emphasize here.
You want me to put a 200-day moving average in, yes?
Please.
Okay. I've made a nice turquoise color. because I know you like turquoise.
So
there's a $200. Yeah, I know. There's the 200 simple moving average put in.
Yeah, so what I would like to emphasize is this last trading sessions, gold actually fell below 200-day moving. And as we keep emphasizing, that's like sort of important line in the sun, especially for institutional investors. But now it has recovered. So now I see, based on my own chart, that it's getting a bit of support, 8-day moving average, and seems that the stop to the price was put, what day was this? On the 30th of November. The support line actually was the lower Bollinger Band level as well. So a lovely, sort of graph. Unfortunately, I can't put it here, how actually technicals work, meaning the Bollinger Band does offer support. 200-day moving average was a support. Then it was a resistance. Now it seems to be a support level again. So these things, they are built in models of institutional investors who move.
Yeah. Like I say, as you can see here, when it did break down below the SMA, the 200 SMA, it did act as a minor resistance. But now, since the last two trading sessions, it's now broken back above it, and as you can see, you're rightfully said, the SMA there is acting as a support for gold as it stands. So
maybe the next 2 or 3 days how it's gonna go, price action. But again, gold, interesting asset. Sometimes inflation hedge, sometimes deflation hedge. We'll see.
It is. Well, I say I have a personal relationship with gold. Not that we're married or anything, but it was actually the very first asset I ever traded back in 2006, I think it was. So yeah.
How young you are.
Well, no, don't worry about that. Don't ask me that. As my grandma used to say, I'm the same age as my little finger, but a little bit older than my teeth. But I remember when I started, and I've always had a relationship with gold. I've always looked at opportunities with it. And I remember when I first started, it was trading at $683 an ounce.
Wow.
683. I know. But anyway, should we move on? I can't even remember that level now, Should we move on to our technical indicators? What indicators we're going to discuss today? Should we move on to that?
Lovely. So we have a few prepared for you today. Just DMI plus DMI during our previous sessions, and we have touched those very lightly today. So DMI stands for Directional Movement Index. Basically, compares to prior highs to prior lows, and basically if we have another higher high or lower low. And DMI is a good indicator to show the strength of a trend. And this is very important for those traders who are momentum traders or trade following. Not that much for contrarians or sort of event-driven traders. The logic is very simple, actually. If DMI plus DMI minus means that there's more upward movement, and also the vice versa is true. But if you have more upward movement, again, you have that momentum in place. So most likely, we're all operating on a probability scale whenever deal with certainties. It's always uncertainties. But if DMI plus is above, means that most likely we're going to see more momentum. And if DMI is dominant and rising, meaning like you can see DMI slightly pointing higher, most likely the price is also going to move higher. There's no absolute value of DMIs, but there's sort of market consensus that if DMI is below, if both DMI are below 25, it means that there's no trend, there's no dominant force. So market is maybe moving sideways, or there's volatility, or there's a lot of gap trading, meaning like price opens a lot higher, a lot lower than it closed. So I wouldn't use DMI in that situation. And if DMI is a 25, then you can see trend forming, meaning like some one side is going to be dominant, either the plus side or the minus side. And quite a few traders actually use crossovers for signals that are emerging, potentially emerging. But of course, it can give you a few false signals as well, so you have to follow that.
Yes, of course. So you're saying when the crossover, is it similar to the simple moving average crossover for audience?
No, actually, when DMI plus crosses over DMI minus, then you could actually have a emerging bullish trend.
Okay. Okay. So it's like a golden cross or the death cross with moving averages then.
Yeah, exactly
Very
the
similar.
same. Exactly the same.
Oh,
Yeah.
okay. Very good.
Can we put it on a chart just to show how to scale up an MT4?
Absolutely. Do you want the euro dollar? Okay, as the instrument.
Love it. One of my favorites again,
Perfect.
especially this week.
There you go. Especially this one. Yeah, absolutely. So, is there any particular period you want me to set it for?
I prefer 14 days for those who do trade trading.
Days?
Not
Okay.
for day trading, but those who trade the daily price. 14 days, brilliant.
Okay. All right. So I'm adding it in here now. There we go.
The color is a bit tricky to read. So just doing my best with my
let me. I tell you what I do.
Here.
Give me a second. I'll change it. Let me see if I can change the color to make it a bit more easier. If it lets me. Here we go. Okay, it's dark blue. I shouldn't have chosen dark blue, should I? Can you see it a bit?
Preference. Would you again use the logic I have? I use green color for DMI. I use red color for DMI minus, making my life as easier as
possible. There you go. Green 14. Try it now. Is that better?
That is better. A bit hard to read. Is there 3 lines? Why is there 3 lines? Is there ADX also automatically?
I believe the ADX is in this as well.
So we're slightly getting ahead of ourselves and adding ADX, but maybe we did, and then we discuss them as a sort of package, because these things, I mean, DMIs and ADX, they come as a whole. So let's review ADX in parallel while you set up the chart.
Okay, no problem.
It is average directional index, and that shows the strength trend, indicates whether the trend is either gaining or losing momentum. And again, 14 days is a very sort of common period to use. For ADX, what's important is the direction, meaning that anything below 5, it's meaningless. I wouldn't even look at it. The moment your ADX is reaching 25 to 50 level, it means a strong trend in place. I give an example. Let's say I see DMI plus 35. I see my DMI minus 10, and I see ADX 25, meaning my DMI is the dominant force. ADX is meaningful. For me, that would say there is a strength in the bullish trend. And if my moving averages are also stacked, say in the rainbow fashion that we have so many times here, that tells me I may actually trade this asset or this instrument.
Yes.
Can we look at it?
Yeah, I've got excited. I'll put it on this is the ADX I've put in here. This one here. It's actually the DMI I couldn't put it. So this is actually the ADX here at the bottom here.
Yeah, so we can see that, unfortunately my librarian glasses are not strong enough, so you have to tell me what ADX at this point.
Okay. Well, like I say, we're the 14 is just above about 34 according to this indicator here.
So ADX tells us there's a very strong the prevailing trend is strong, and DMI plus would tell us if it's bullish, bearish.
Yes, and as we can see at the moment, this is the euro dollar I have on the chart, and we are seeing a bullish momentum. This is again, it's on the 30 minutes on the chart. If I use it to a daily, we can see indeed that, like I say, the euro is bullish against the greenback at the moment. So the ADX is showing us that.
Exactly, and again, ADX and DMIs are not to be used alone. Always the ones that help us to confirm whether our thesis is correct. Like we discussed during our previous webinar last week, before you enter a trade, you have to have a thesis. Let's say I think euro dollar is gonna gain. Either it's the reason my moving averages are stacked, or I think that Joe Biden is great for European assets, or whatever my reason is. And then I look at the chart. Oh, X is at 34. DMI plus is dominant compared to DMI minus, and I'm like, yep, technicals are supporting my thesis. So potentially I would enter if this is what my thesis was.
Exactly. And remember what we said last week. Write it down in a trader's diary.
Exactly.
Exactly. What's the next one we're going to talk about?
next we are gonna cover Parabolic SAR, or SAR as they like to call it. So SAR stands for stop and this is used for trend direction and potential reversal price. So normally SAR is on the chart as small dots, and if the dot is the price, it means the price is moving up, and vice versa. So interesting one because it constantly moves. Even if your price is moving sideways, the way the formula for SAR is formulated, SAR always jumps up and down. So this particular indicator is only to be used when the markets are trending. Never use SAR for an asset that's sideways or is down, because it can give you a lot of false signals. And it can be used for, let's say, stop loss or profit taking. So, for instance, if you are trading a bullish momentum and your SAR jumps, then you may think, okay, potentially technical are giving me the signal that the price momentum is sort of decreasing. And it looks at highs and lows during a certain period and applies acceleration factor.
Yes. Very good. Should we show the good people how we put it on our chart?
Lovely. Let's do that.
Let's do it. Okay, I've got the cable here. This again is on the daily. Okay. So here we go. So we go obviously indicators, trend, Parabolic SAR. Okay. Dark green. What color would you like? Because I choose the wrong color last time.
Not the wrong color. Something easy to read. So I like maybe cyan for that, or yellow, or something that really pops out.
Okay. How about orange?
Oh.
Is that okay? Does that work?
That's brilliant. It actually very well how SAR sort of confirms that, or it doesn't. In this case, we have quite a long trend since October, so you can see how SAR sort of confirms price action. We have something good that we can use. Maybe we can show euro dollar was maybe moving sideways for weeks. Maybe we can show euro dollar as well, how SAR can be a bit confused.
This is euro. This is euro dollar on a daily.
Yeah. So I point out that from August on the price of SAR would not give you very good sort of indication what's happening with the price and the direction. So price down, while SAR can still go higher. So there can be divergence between price action and SAR movement. That's very important to note.
Yes.
But again, if you use SAR for, then it will maybe help you to get out of a position that's momentum.
Exactly. Well, like I say, and like I say, it's a very useful indicator to use for either stop loss and take profit as well. So it does combine the two great attributes of indicators, giving you potential direction, but also giving you a safety net and a potential goal as well, which is very, very useful. We got what's our next one? We got Fibonacci, I think, isn't it?
We got one more, and that's Fibonacci retracement levels. So first of all, what is Fibonacci? We just call them Fibos. Honestly, makes life easier. Who has time for the full word, right? And it's mathematical sequence basically that goes until infinity, and it's this two final number particular sequence added up. You get the next one, and the way Fibo sequence an interesting one. Repeating in galaxy formation, for instance. A lot of the antique architecture you see sequence. So people have sort of applied that to trading as well. And the way to use Fibo retrace, we take two extreme points. We take
the low and the high if it's an uptrend, and the high and the low if it's downtrend. If I'm right.
Exactly, and some people use it also to do it within the sort of bigger swing movement. They use it for the shorter pullbacks as well. So it really depends style and the time frame that you are trading. And one the Fibo levels, there's multiple tools, for Fibo. Those horizontal lines. I put 50% there as well, although technically it's not Fibo level, but it's used a lot. And Fibo is that it doesn't really give you the direction, it doesn't give you the trend, doesn't give you the strength of the trend, but it shows a a potential resistance level, support level, and you can use those maybe again for entries or stop loss or profit taking.
Yes.
Heavily used by traders. A lot of models have been around Fibonacci retracement levels. So this has become sort of self-fulfilling prophecy because institutional use that a lot. And it's also applied to other trading techniques such as the Gartley patterns and Elliott wave theory, which you have mentioned the last time.
Yeah, I like the Elliott wave theory. I definitely think we should discuss the Elliott wave theory in future episodes. But no, I mean, you said something just a moment ago that Fibonacci retracement is very, very popular, and in some ways it does, because a lot of people are using it. It does become like a self-fulfilling prophecy, doesn't it? And I think you're absolutely right on that. I've got gold on my chart to show Fibonacci because I think there's some really interesting levels and a really interesting way to display how Fibonacci can sometimes work with your trading. So if you go to my chart now, okay, so I'm going from the low all the way to the high, okay, and there we have it. We have our levels across, and again, like I say, if we have a look here, this was the 23.6 level. It did, after its initial, obviously, bull run, act as a support where the market jumped in again and started buying again. Once that broke, the 38.2 level, again, as you rightfully said, acted as a support, and the 23.6 acted as a resistance where the market ranged for a bit. There, since the ninth, like we said, gold has come under an awful lot of pressure. We have seen since it break the 38.2 level, and it came to that level, like you said, that traders use, or some traders use, which is the 50 level. And that's where it came down to before the market started to jump in again. And as we stand, rightfully said, the 38.2 is now acting as a resistance. So I think this is a brilliant example of Fibonacci retracement actually at work. And I think it clearly shows that, you know, sometimes it becomes a very, very useful indicator.
Yeah, important to note is that, you know, with all these sort of resistance and support levels, these are never one price point. These are always a price range. So although, let's say, the Fibo line may not be exactly where the price action took place or where the price was stopped, you can see a pattern there. So it's a range where the price gets stopped. Sometimes these charts, I mean, depends on the asset class, may differ between different traders because they use different source, different liquidity, and so forth. But it's important to take note that, again, this indicator is used by, I don't want to say all institutional investors, but a large so definitely the levels are going to impact this action. And you know, already see their gold is up by Fibo level, which is brilliant. Exactly.
Yeah, it is. Like I said, when we discussed what indicators we were doing today, and you said we were going to do Fibonacci retracement, I went, I know exactly which one to use because I've been using it on gold recently anyway, and I've been watching it with gold. So yeah, this is a perfect example, I think, of Fibonacci at play. Definitely. I think we've got some questions. Should we go into questions?
It's my favorite part always.
It is my favorite part too, because as I always say, ladies and gentlemen, it's so nice to receive your questions because we are like sort of we like the interaction because we make these little live broadcasts for you good people, for your education. So whatever you need to know, let us know, and we like to do it. So Mike, if you can take my chart off, I can get to the questions. Let's have a look. That's my producer. There we go. Right. So let's have a quick look at some of my questions here. Here we go. Right. First question, which we've covered already in this episode. And the question is, how do I use Parabolic SAR in timeframes? Okay.
So personal preference is not to use Parabolic SAR as a key indicator for me. If we talk the sort of different indicators during our sessions, and those who haven't seen first a technical trading session, please go to our YouTube. There is the video section and there's the previous live stream section. You can see our first one. Auto hierarchy for me, personal preference, moving averages. Then I use RSI. I use stochastic. Then I use DMI. I use ADX, and the SAR. So it's literally like the last thing just for me to see what is this? Is this confirming my story or not? Is this confirming? I would never take any trading decision based on that. However, I may trade because SAR. So SAR could be the stop loss for me.
Yeah, I got you. So it's like I say, unless everything is telling you pretty much the same thing, including the Fibonacci SAR, you don't necessarily jump in. What sort of time frame? What do you have a preference on time frame in particular?
I do. I use daily charts again. Personal. I don't have. If you want to be day trader, you have to be at the computer the entire time. You know, trading. You know, I have to speak to you at least an hour per day.
Yeah, well, there you go. There is that too. Yeah, exactly. Another question is here. I think we can come in, maybe discuss a bit more about this in future episodes. But one of the questions we have there is how to make a strategy and be a consistent, profitable trader. I think that's a very rounded question. I don't think there's one absolute answer or single answer for that. And maybe this is something we can maybe look at strategies in the future, or strategies which work for you in later episodes. What do you think?
But I think we have covered that, and that was in risk management section when we were talking about the sort of trader journal. So that's one very important point to have in place in order to be profitable, because that helps you to analyze your trades and see what you've done wrong potentially. But of course, there are different ways how to look at the markets. So we have mentioned a few here. We have mentioned the momentum trading. We have mentioned the event-driven trading. We have mentioned contrarian trading. And yeah, we can put together a session to talk about the differences between these, you know, sort of schools, and you know, everyone can decide what do they prefer, what's their expertise, or.
Well, yeah, because I totally agree, because I actually personally feel that trading is very personal. So what one style or one strategy may work for one person, it may not work for yourself. It's very individual, I think. And I think, as you rightly said, like we discussed last week, one of the prime ways of discovering what type of trader you are and who you are as a person is doing a trader's journal. Another question here is, what are the main confirmation candles which are highly profitable? So I'm thinking they're asking the question, what is the main confirmation candles which you can spot? Again, I think that might be a question for us to answer in a later webinar when we maybe do candlesticks.
That's perfect. Thank you so much for the idea. We definitely should cover candles as well, because again, not to be used on their own, but they definitely help to maybe avoid a clear, I don't want to say bad trade, but you know, just that, you know, doesn't agree with thesis, for instance. Given how emotion driven, I would say, trading is. So traders are still people. Even computer algorithms are built by people. There's always a bit of human factor, and candles often confirm that human factor that we see on the charts.
Yeah, there's always a human nature somewhere along the line, definitely. But I think that's a great suggestion. I think we should do a specialized webinar, maybe just on candlesticks and potential patterns to help with their trading. That's all the questions we have for today. So that's a good show. Brilliant. Right. Before we sign off, should we say goodbye now?
Thanks everyone for joining. Lovely session as always. We appreciate your questions. We appreciate your comments and feedback. Please shoot us an email if you have any suggestions how to improve the future shows, and what are the topics you want us to cover.
Absolutely right. Please keep coming in with those questions, coming in with those topic ideas, because like I say, at the end of the day, these little live broadcasts me and Kaia do are for you, and we love hearing from you. Okay, on that note, remember, these little live broadcasts have been for educational purposes only, and in no way whatsoever should be taken as advice. As always, I always suggest you do your own research and your own due diligence, and of course, know the risks involved before entering any trade. Till next time, every single one of you out there, trade safe.